All right, welcome everyone to another video about support and resistance. In this video, we're going to be diving really deep into the conceptual understanding as to what exactly support and resistance is. We've talked about it previously, and I'm sure many of you have heard about the concept of support and resistance before in the financial markets, but the purpose of this video is to actually show you why support and resistance forms. That way you have a deeper confidence in what you're actually doing in the financial markets, and that's going to improve your trading and overall profitability. So we are going to end up in the charts a little bit in this video, but of course before we do that, I'd like to take us right on out. All right, so let's say we've got a resistance up here at, let's just go ahead and type this in here. Normal 2 coordinates, let's say 1370, right around there. So we have a major resistance at 1370. Now, we've got price is moving along, comes up to our resistance and falls. Comes up to our resistance and falls. And yes, of course, there's a support down there, but right now, I want you guys to focus on this resistance. Comes up to the resistance and falls. Now, here's my question to you. What causes support and resistance? What causes price to come up to this seemingly random level in the market and continue to find resistance and bounce away? What is it that's causing that? So I'm going to give you a couple seconds. Think about it. Think about some ideas. Maybe pause the video for a second. The answer to what's causing support and resistance in the financial markets is supply and demand. Now, supply and demand is the underlying factor that drives every single piece of technical analysis, every single price movement. It's the reason for everything. People may see something in the market and blame it on news. They might blame it on politics. They might blame it on a technical analysis pattern. They might blame it on buyer sentiment. At the end of the day, every single move in the financial market is due to supply and demand. And it's so important that you understand this from a conceptual, fundamental basis. That way you can grow from this and truly understand what you're doing, because most people, especially when we talk about retail traders, they just don't have the grip on the market that they need to be successful. So support and resistance is caused by supply and demand. Support and resistance is supply and demand. They are actually the exact same thing. So what exactly is supply and demand? How does it play out in the markets? All right, so first I want you to imagine that there's a large investment bank. So there's an investment bank, and this investment bank needs to move $100 million. All right, now when you have that kind of transaction going on, you can't just place $100 million of order at one time. So what they have to do is split this order up into several different orders. So instead of placing a $100 million order, they may place a $20 million order 5 times, or they may place a $50 million order or a $10 million order and split it up into smaller pieces. The reason why they have to do this, so let's go ahead and pull out our line tool here. And let's just say that right here at 1340, let's go in here. So 1340, and make this our, here we go. Right here at 1340, they want to fill this order for 100 million, okay? So the way this works is price will be moving along here in the market, and then it'll reach the 1340 level. And when price reaches the 1340 level right here, part of this order is going to get filled. So let's say overall they want to fill 100 million right here. Let's say they had an order for 25 million. All right, they had an order for 25 million. Now when this order actually fulfills, what's going to happen is it's going to cause price to shoot up. All right, so when they click buy for $25 million, it's going to cause the price to rise because there's more demand caused by this investment bank. Guys, one thing you have to understand, and we're going to dive a lot more into this. It's honestly more advanced than you need at this point, but general concepts here. The financial markets are controlled by large players, by key participants, institutional investors that have so much money that it causes the value of assets to change. So when they place an order for $25 million, price rises. Let's say price rises up right to this area. Okay, so price rises. So price rises up to here. Now, here's the question. When price rises up to here, when price rises and we're up to here, are we down here at 1340 anymore? No. So what this is called is, go ahead and pull this over here. This is called slippage. So slippage occurs when you carry out a transaction that has so much volume that it actually causes the market to move. It causes price to fluctuate away from that point. And so when that happens, the institution has two options. Either they can continue to place orders or they can wait for price to return down to their original price point that we've got marked of 1340. Now, remember and keep this in mind, okay? This is very important. When you talk about like a 5% increase for $100, okay? 5% increase on $100, you're paying an extra $5. So in that case, you might be okay with that markup. But in this instance, when you've got $100 million on the line, a 5% markup is $5 million. So when you start scaling money up to this level, these investment bankers, they can't afford, okay, these hedge funds, they can't afford to continue to fill their orders once slippage has occurred. So that's why they have to split their orders up into several different parts, because it would cause a volatile push in the market, and a lot of their order wouldn't get filled at the price point that they need it filled at, and therefore they would lose a lot of money. So this is the underlying driving factor for actually why support and resistance forms in the first place. So here we go again, price is up here. And now keep in mind, our investment bank has another order down here for $25 million. Again, they can't just fill the other $75 million because that would be too much. It would be too much slippage. They'd lose too much money. Price would rise all the way up here, and they would get, have to fulfill another $40 million up here at a much higher price point, and they'd lose a ton of money. So here's what's going to happen. Price will ultimately come around, and then boom, it will find this level again. When price reaches this level, what's going to happen? This order right here, this $25 million order is going to get filled at 1340. When that order gets filled, it's going to cause price to rise. When $25 million of asset is bought, it will cause the value of that asset to rise. Price will do its thing, and then when price comes back down, what happens? Another $25 million is filled right here. So order is filled right here. Okay? So each time price reaches this level, it's filling orders. Now watch what happens, because this is interesting. So we get one more order fill here. Let's go ahead and mark that right here. Okay? We get one more order fill right here. Now notice how at this point we've got $25 million times 4. That's $100 million. So the entire original order that this bank put for the market right here, it's all been filled. So they're done. They're good to go. They have no more orders waiting here at 1340. So what's going to happen now? So price is pushed away, right? When this $25 million order is filled, it pushes price up. What's going to happen now when price returns to this level? There's no more buy orders there. So now what's going to happen is price is going to break this level, retest, and then continue down. So this area down here, I'm going to get rid of this, get rid of slippage, get rid of this. Okay, now these orders down here have formed what we typically call support. Okay, this is what we would call support. Now that makes sense, of course, right? Prices come down, it's found support here, it's found support here, it's found support here, it's found support here, and it's retested as resistance here. So it makes sense based on our understanding of support and resistance why this is a support. However, now you understand why this support level in the market is actually forming. So what I'm going to do is I'm going to change our word support to demand. Let's move this right over here. And then I'm going to change all of this to green. All right, now why did I change all of this to green? The reason why I did that is because I'm going to go ahead and move this down here now. Support is equal to demand, which is equal to buyers. So anytime you hear the word support or demand, you need to think buyers. There are buyers in the market. So in this case, right here at 1340, we had a buyer in the market that kept pushing price up. Every time price got there, there were buyers there ready to push the price up. When you buy, the price increases. Now, that's support. That's demand. What about resistance? What about supply? Well, same thing, just opposite. So we've got our level up here now, and we're going to make, this time we're going to make this red to indicate sellers. Okay, so that's the idea, color coding this here. Green is for our buyers, red is for our sellers, and they are pushing the market back and forth. So again, similar situation here. We've got sellers here, sell orders filled here, sell orders filled here, sell orders filled here, and sell orders filled here. How much? Who knows? Doesn't matter. This could be 10 million. All right, this could be 5 million. This could be 70 million. It doesn't really matter. What matters is that you understand the concept of what's going on here. You don't need to know the exact amount. You just need to understand that every time price gets up to this level, okay, so in this case, let's say it's 1360. There we go. So every time price gets up to 1360, sellers are coming in. There's sell orders there. They have pending orders ready to be filled. Because remember, our institutional seller up here that has to move $20 billion can't do all of that in one order or two orders or three orders due to slippage. They have to split that up contractually into separate orders with their brokerage, and then that brokerage will carry out those orders only within a set defined parameter of price. That's what gives these support and resistance zones. All right, so just remember, these guys up here who have these sell orders at 1360, they've got a lot of money on the line. They cannot afford to have their orders executed right here or right here. Okay, right here. They need to wait for price to come back up to 1360 so that they can continue to get their orders filled at the correct price. All right, and what's the result of these orders, this supply and demand in the market? You end up with support and resistance, inherent barriers in price, and you're able to accurately predict where the sellers are going to come in, where the buyers are going to come in, and where you too should be placing your trades. So up here we've got resistance equals supply, which equals sellers. Okay, so this is important for you to remember, take note of. Resistance, supply, sellers. Okay, support, demand, buyers. So supply, those are your sellers. Demand, those are your buyers. So price moves between support and resistance. Supply and demand is what creates that support and resistance. One more time. Supply, that's your sellers. That's the sell off. Those are your peaks. That's your resistance. Demand, those are your buyers. That's your support. Together, supply and demand move the market. Together, supply and demand create support and resistance. Now that you understand why horizontal support and resistance, because that's ultimately what we're talking about in this case, specifically horizontal support and resistance. Now that you understand why it exists fundamentally, let's talk about something else that's really important. All right, so I've cleared off the screen a little bit, and I want to ask you a conceptual question here. Let's say that you open up the chart and you are right here. So price is right here in the middle between your support, your resistance, between your supply, your demand, and price is approaching this supply zone. Okay, now here's the question. If you look back and you see that price has been here once, twice, 3 times, 4 times, and this is now the 5th time you are approaching the supply zone, do you think that because you have more bounces from this level that you have a better trade, or do you think that you have more bounces from this level that you have a worse trade? And I want you to think about this for a second. So pause the video if you need to, but I want you to really think about this. Do you have a better or worse trade? Are you ready for the answer? The answer is that the trade is worse. It's a worse setup. And here is why. The reason why it's a worse setup is because, remember, again, there is a certain number that's being filled here. Let's say 100 billion. So $100 billion worth of sell orders are right here at 1360 on the chart. Okay. Now each time that price is visited up here, a part of that has been filled. Now you don't know what part of that was filled each time, but right here part of it was filled. Right here part of it was filled. Right here part of it was filled. Right here, part of it was filled. And now here we are. And the question is, let me get rid of the billion here. The question is this good or bad for us? Get rid of that. The answer is it's bad, because at this point, we've already visited this level so many times that each time we visit this level, okay, write this down, take note of this, is very important. Each time we visit this level, it becomes more and more likely that all of the orders are going to have been filled. It becomes more and more likely that there are no more sell orders remaining. It becomes more and more likely that this level will break and price will continue on as if it didn't even exist. Why? Because all the orders have already been completed. It goes against your intuition. You would think that the more bounces, the more verification you have for a level, the better it is, but that's not actually the case. You want to work on identifying these levels back over in this zone, back here when you only have a couple bounces. You don't want to be identifying the level all the way over here once it's already got 5 or 6 bounces. The orders are already filled and you're going to lose the trade. The one time you go ahead and decide to enter in on the trade, you're going to lose the setup. And again, this is something that just so many retail traders don't understand because this kind of information is not out there for people. People are taught that the more reactions you see, the better. And it's the exact opposite. And that's why so many people, that's why 95% of these people are losing money because they're taught incorrect information. And when you actually understand what it is that you're looking at on a chart, everything becomes so much more clear. So again, one last example on this. I'm going to clear the screen off. All right, let's go back to our demand zone down here. And let's say we've got $50 million worth of orders to fill. All right, now over here, when price originally got here, they were able to fill 20 million of that order. And then the second time that price got here, they were able to fill 20 million of that order. And then the third time that price got here, they were able to fill the remaining 10 million of the order. And then the order was complete. That was it. So after that, when price got here, there was nothing left. So what would that look like in terms of the candlestick? So let's delete these here. Let's talk about that real quick. So each time this $20 million was filled, price rose back up to 1360, our next supply zone. You can see that right here, and then you can see that right here. But this time, they only filled 10 million because that's all that was left. So the question is, did price make it all the way back up to the supply zone? No. It was half the order, and so it went half the distance right here. So instead, in this case, price stops halfway in between, comes back down looking for more demand, more buyers, more orders to fill to push it up. And if there aren't any more orders, which in this case we have no more orders left to fill, what happens? The level fizzles out like it never even existed, and price will break it, retest, and continue on in the other direction. So I hope at this point